Well, hello, I'm back again for another installment of This is How You Solve the Problem. Um, I'm looking at problem 2.15 on page 82 in chapter 2 of Understanding Financial Statements, 11th edition, Fraser and Ormiston. This is an inventory problem. So when you're looking at a balance sheet, okay, say for a retail company, and you look and you see inventory on the balance sheet, that is their merchandise inventory that they have for sale. They typically purchase that either directly from manufacturers or if it's produce, if from growers, farmers, whoever, or from some middleman, a wholesaler. If it's a manufacturing concern, then they have a raw materials inventory, a work in process inventory, and a finished goods inventory. But the valuation question about inventory is an important one. And there's a couple of different methods that you guys should be familiar with. The first in, first out method, the last in, first out method, and then average cost. Those are the three primary methods we teach you guys about. Are there other ways to value inventory? Well, it's accounting. And it's business. It's a social science. I'm sure there are variations on all of this, which you don't need to know because if you're not an accounting major, it would just complicate things too much. So in this problem, they have two requirements they want you to complete. First requirement is compute the inventory balance and the cost of goods sold expense reported as the end of the year using the following three methods, the ones we just talked about. And then B, discuss the effect of each method on the balance sheet and income statement during periods of inflation. So that means rising prices. Again, I take the information that's in the textbook and I enter it into an Excel spreadsheet because it's easier for me to work with. It's nice and neat. Nobody has to rely on my sloppy handwriting. And also, it's easy to correct mistakes as you move forward. So what we have here is a series of, I guess, transactions. So here we have a beginning balance on January 1st, and then we have purchase and sale activity all the way through to the end of the year. Notice that the sales activity is aggregated by quarter. So we have the first quarter, second quarter, third quarter, fourth quarter, and then we have individual purchases that occurred throughout the year. So when we first take FIFO, first in, first out, and we want to calculate the numbers using FIFO, this is what my answer ends up looking like, and I'm not happy with that particular view. Hold on a second. Sorry about this. I'm just trying to get it so that we can see the entire answer. And there we go. And I'm going to have to shrink it up a little bit. Okay, there we go. So I took the same information, the same data, okay, that they gave us in the problem, and I just extended, I calculated a total cost and a total sales price. I summed the total cost, $151,000, total sales, $177,000. Again, I just used simple formulas to come up with that. Then I also wanted to know about units. Well, I added the beginning. Okay, this is what I did here is I did sum if the cells B2 through B10 equal purchase, okay, then it would sum cells C2 to C10 plus the sum if B2 to B10 equals beginning, sum up C2 to C10. So this is kind of a compound formula where I took two sum ifs and added them together to come up with the available units of 38,000. Then sales is just sum if it was sales, and so we get 31,000 units in sales, and the difference between the two is what we have in ending inventory. Now, this is first in, first out. So when we have the sales here from January 1st, so these are the first quarter sales, so we sold 8,000 units. Well, those 8,000 units, where do they come from? Well, those 8,000 units, remember, it's first in, first out. What were the first ones in? The 10,000 in beginning inventory. So all 8,000 units were sold out of the 10,000 in beginning inventory. And remember, that doesn't actually have to mean that those were the actual goods that left, although most of the time you want to rotate the stock. But in this case, we're only talking about the costs associated with these inventory items. So the costs associated with the 8,000 sold here are those costs tagged to the 10,000 in beginning inventory. So you now have 2,000 left from beginning inventory plus the 4,000 purchased. And that total ends up being 8,000 times $3 per unit, or $24,000. So that's your cost of goods sold for that particular set of transactions. Now, for the sales for the second quarter, where they sold 11,000 units at $5.50 per unit, they generated revenues of $60,500, and their costs associated there were $40,000. And so where did that come from? Well, it was the 2,000 remaining units from the beginning inventory. Remember, we started off with 10,000 in beginning. We sold in the first quarter 8,000 units, and we took those out of the beginning inventory. So that reduced that from 10,000 down to 2,000. So now we've used up that additional 2,000. Then we had a January 10th purchase, and so 4,000 units purchased on January 10th are going to be used up in the second quarter sales. So it's 2,000 that remained from beginning, plus the 4,000 units that were purchased on January 10th, and then 5,000 units purchased on April 25th. So what's left is going to be 5,000 units from the April 25th purchase, because 5,000 of those units went to satisfy the second quarter sales. When you add up the costs associated with that, the formula up here says it's 2,000 times 3, which was the 2,000 left in beginning inventory, times $3 per unit. The 4,000 units from the January 10th purchase times the unit cost of $3.50, and then 5,000 of the units purchased on April 25th at $4 per unit. That's how you come up with the $40,000 cost of sales there. When we come down to the third quarter sales, we sold 3,000 additional units at $6 per unit and generated revenues of $18,000 against costs of $12,000. How did we determine those costs? Those costs are essentially 3,000 units from the remaining 5,000 units on the April 25th purchase. Remember, we used up 5,000 of these against the second quarter sales. That still left us with 5,000 units. Then on July 10th, we purchased an additional 6,000 units. So we have 11,000 units in stock. Okay, we're selling 3,000 first in, first out, means we go back to the April 25th and use up those units first, the costs associated with those units first. And so we have 3,000 units at $4 per unit. And that leaves us with 2,000 units from April 25th and the 6,000 units from July 10th in inventory. Then we have the fourth quarter sales. We sold 9,000 units at $6.50 per unit. We generated $58,500 in total sales revenue at $40,000 worth of costs. Now, where did those costs come from? So let's do this again. First in, first out. So what did we have left? We had 2,000 units that were remaining from the April 25th purchase here. So those 2,000 units get used up at $4 per. Then we use up the 6,000 units that were purchased on July 10th. So that gives us 8,000 units. And then we had a purchase on October 15th for 8,000 units. We use 1,000 of those units against the 9,000 units sold in the fourth quarter. And so we have 2,000 units at $4, plus 6,000 units at $4.50, plus 1,000 units at $5 gives us a total of $40,000. Then when you add those numbers together, you have a total of $116,000. So that's your cost of goods sold. And so I have that number here. The ending inventory is the 7,000 units, okay? And those 7,000 units all come out of the October 15th purchase, and so they're at $5 per unit. And so The total available, when we add those together, is $151,000, which matches our total cost for all of the items purchased, $151,000. So we've accounted for everything that we need to account for. And so that's FIFO, first in, first out. All right, next we're going to look at LIFO. And we have two LIFOs here. One we're going to take a look at the periodic, and one we're going to look at the perpetual. And there is a difference between the two. And so we'll kind of go over what those differences are. So here we go. So same set of data. No differences here. Okay? So I won't bother to go over all of this. So for the first quarter sales of those 8,000 units, it's 8,000 units from the 10-15 purchase. Okay? And that's because it's last in, first out using periodic. So why are we jumping all the way down to 10-15 for this? Well, the reason why is because under a periodic system, we calculate the cost of goods sold at the end of the accounting cycle. So that means that we know all of this information by the time we go back and calculate it. And so therefore, we take 8,000 units from the 10-15 purchase, and it's $40,000 per. So it's $40,000 cost of sold because it's 8,000 times $5 per unit. Okay, so it's $40,000. For the 11,000 units that are sold in the second quarter, okay, 6,000 units come from the July 10th purchase and 5,000 units from the April 25th purchase. So you notice we're working backwards. We were working forwards when we were doing FIFO. Now we're working backwards. And so we have 6,000 units at $4.50 and then 5,000 units at $4. That totals $47,000. Then for the third quarter sales, we have 3,000 units from the April 25th purchase. So that means it's 3,000 units times $4 per. And so that gives us $12,000 cost of goods sold against the revenue for that period. And then finally, for the fourth quarter sales of 58,500, we sold those 9,000 units. 2,000 of those units come from the April 25th purchase. 4,000 units come from the January 10th purchase, and 3,000 units come from beginning inventory. So that means the 7,000 units that remain in ending inventory are in there at the $3 unit cost. And so we add these numbers up and we get $130,000 for our cost of goods sold. The ending inventory is valued at $21,000. Again, we sum those, it's $151,000, matches our total cost, $151,000. We know that matches, so we're good to go. So again, difference between FIFO and LIFO using the periodic system. We have $116,000 cost of goods sold. And remember, this comes off the income. So we have net sales minus cost of goods sold equals gross profit. So with the same amount of net sales, okay, the same amount of total sales, $177,000, we're going to report a higher gross profit under FIFO than we're going to report under LIFO. Because here we're going to report $177,000 minus $130,000. Here we're going to report $177,000 minus $116,000. Now, what happens if we use the perpetual system where we keep track of this? That means that instead of going all the way to the back to the end of the cycle, the end of the year, now we're doing it for every transaction. So when we come up with this first sale here, the first quarter sales of 8,000 units, this is all we know about here. And so we sell from the 8,000 units here sold, 4,000 of them come from the January 10th purchase. The other 4,000 come from the beginning inventory. And so that means there's going to be 4,000 at $3.50 plus 4,000 at $3 comes up with $26,000 is the cost of goods sold. Then for the second quarter sales of 11,000 units, we have 10,000 units coming from the April 25th purchase and 1,000 units coming from the beginning inventory. So that means We have 10,000 times 4 plus 1,000 times 3, which gets us $43,000 in cost of goods sold against the $60,500 in total sales for that particular quarter. Then, for the third quarter, we sold 3,000 units. Those 3,000 units are going to come from the July 10th purchase. So the July 10th purchase was at $4.50. So it's 3,000 times 450, which comes to $13,500. Then fourth quarter, we sold 9,000 units. So 8,000 units are going to come from the October 15th purchase. 1,000 units are going to come from the 7/10 or July 10th purchase. And so we have 8,000 times $5 plus 1,000 times $4.50 gets us a total cost of goods sold of $44,500 for the fourth quarter. We sum up each of the quarter's cost of goods sold and come up with $127,000. That comes down here. Then the ending inventory is $24,000 because it's made up of 5,000 units that come from beginning inventory that didn't get sold off, and then 2,000 units at $4.50 that come from the July 10th purchase that were not sold off. And so that's $24,000. Add those together, it's $151,000. It matches our total cost, $151,000. We have accounted for all of the costs, and so we're good to go. Okay, compare the two LIFO methods. Under the LIFO, under the periodic system, we report a higher cost of goods sold than we do under LIFO using the perpetual system. Okay, and that means that the ending inventory under the perpetual system is higher than it would be for the periodic system under LIFO. Let's go to average cost. Under average cost, this is fairly straightforward. We calculate the average cost per unit, okay, which means we take the amount from F11, which is our total cost of $151,000, and we are going to divide it by what's in C12. C12 is right here. It's our available units of 38,000 units. So we get an average cost per unit of $3.97. So we have our cost of goods sold ends up being C13, okay? C13 is our total sales, 31,000 units, times the average cost per unit, $3.97. And so we end up with a cost of goods sold of $123,184. The ending inventory is 7,000 units, and it's at the same $3.97 per unit. That's the average cost for the period. Add those together, $151,000 matches the total cost, $151,000. Bingo, we're in business. Okay, again, this is assuming periodic. Okay, this can also be done using the perpetual system. And you have to continually update and recalculate the averages as you go throughout the year. They didn't ask you to do that, but they could have. So let's look at the effects. So assuming positive inflation over time, the last in, first out method states cost of goods sold at current costs. First in, first out understates the cost of goods sold. Okay, the average cost creates a cost of goods sold that's between the other two methods. Now, why does FIFO understate the cost of goods sold? Because it's taking the older costs and matching them against the current sales. So that if they bought something 6 months ago and they sold it now, they're matching the cost from 6 months ago against the revenue that they collected or earned today. That's why it's considered understated. LIFO, on the other hand, undervalues the ending inventory because it produces a lower ending inventory number. Because they're matching current costs to current revenues, what's left in ending inventory is the amount that is from the older units or the costs of the older units that are sitting in inventory. And of course, FIFO creates a current cost of ending inventory. The average cost moderates the difference by coming up with something that's in between. Average cost is appropriate to use when the cost of materials are volatile, constantly changing all the time. And so how would you choose between these methods? Well, there's a number of factors that we play. Management's going to make the decision as to what method they use. Typically, they're not going to want to use a method that is going to be so different from everyone else in their industry that their numbers are not comparable. And they can't just change willy-nilly the method they're using to suit the particular inflation or deflationary period that they may be going into. So as the cost of their raw materials or the cost of their merchandise inventory changes, they can't just change the method that they're using to value the inventory at. And also there's IRS regulations that, if you're going to use, I believe, LIFO, if you're going to use LIFO for tax reporting purposes, you end up having to use it for financial reporting purposes as well. And so you've got that kind of kicking in there too. So at any rate, that's how you work through a basic inventory problem. And again, will you have to do it as a non-accountant person? You probably don't. But you should understand, if you're looking at, somebody says, well, our inventory is X, you need to be able to know that, okay, we use LIFO, or we use FIFO, or we use average cost, or we use some combination of them, because you can apply these to different segments of your inventory. So it's important for managers to understand the policies of their own company and what the implications of those policies are on the financial statements. So while you may not be actually working out the numbers and preparing the financial statements, you still have to have enough understanding or enough knowledge, enough comprehension to be able to appreciate how these things are going to affect the financial statements. Because trust me, everybody gets concerned about those. Okay? All right. I think that's about it for this problem. So I'm going to sign off here.